Auto, Nifty IT, and Nifty Pharma Index. All of these three sectors have been trading with a set of losses. However, what is doing well, that includes the likes of PSU banks, private banks, both of them holding up well. Nifty Realty Index with a gain of about 0.4% gains. If you look at the broader end of the markets, that seems to be outperforming the benchmark indices, both the small caps and mid caps, in the positive terrain at this point of time. But with that, let's move on to our next guest of the show. We have Manish Sonthalia, Director and CIO of Emkay Investment Managers, joining us. Manish, good morning.
Good
Markets have
morning.
been range bound, for the past couple of sessions, and all eyes are on the earnings season and the trade deals. But what is the kind of growth that you are expecting from this first quarter results? And with respect to that, how are you finding the valuations?
Yeah, we are in the middle of the earnings season, and as like any earnings season, things are likely to be volatile during this period. But I'm of the very firm opinion that given this volatility, uh, it's a buy on dips. It's an unequivocal buy on dips, and I believe that investors who would buy in this dip would really stand good to reap the benefits that's likely to play out in the second, third, and the fourth quarter. As far as the earnings season is concerned, I think this earnings season, the growth is likely to be Nifty 50 earnings growth is likely to be in the range of around 3 to 8%, give or take plus minus 1 percentage points. And there will be sectoral sectors which will do well. There will be sectors which will not do well. So this is how the entire construct of the markets is placed. I think markets are likely to overshoot on the upside, and this is the period when there's going to be volatility. But make use of this volatility to buy into your favorite stocks.
Okay, okay. Last quarter we saw a major earnings surprise that came in from the mid cap space. What are you expecting from this season? Mid caps, small caps versus the large caps at this point of time?
Mhm. So again, I think this earnings season, the mid caps are going to broadly outperform 20% plus sort of earnings growth YOY. And we have got to figure out how the small cap space is likely to be playing out. But as regards the earnings for the last quarter, even the small cap universe, delivered earnings growth of around 15%. This time around, it's going to be likely slightly lower than that, but still there's going to be decent growth. I think this entire space is more about picking the individual names rather than the index as a whole. But overall, I think the earnings are likely to be better for the mid and small cap when you compare it with Nifty 50 earnings.
Hmm. Okay, okay. We have TCS results, which is due today, Manisha, and everyone has been expecting that it's going to be a negative trend only this time. But anything that you're expecting from the IT pack, even this season, or maybe going forward in the second half of this fiscal year?
Commentaries around the IT space is going to be important, particularly when it comes to translation of the book into revenues. I think not too much of a great expectation from the IT pack this quarter, minus 1.5 to plus 2.5 for the entire range of stocks in this space. I think the thing to watch out for would be margin figures because there's going to be cross currency tailwinds. And obviously, the commentary around how the order bookings are playing out, particularly when it comes to not the efficiency improvement side of business, but for discretionary spends, transformational big deals, and how those the book is translating into revenues. As far as the valuations are concerned, they are probably pricing in the worst sort of situation when you look at or extrapolate the growth around crisis period in the past for Indian IT companies. I think we are overshooting that on the downside. And that is why, again, for the IT space, I would believe that it's a good time to basically look at individual companies and buy. That goes even for TCS.
Hmm. Okay, okay. The entire IT pack has been having subdued growth in the past couple of quarters as well. But that was also on the fears of the rising, US recession. There could be some slowdown fears. But right now, the Trump's tax bill has been passed. And the recession bits has also, been reduced. Do you believe that that could actually aid the earnings growth going forward? Maybe not this fiscal year, but if at least in FY27?
Yeah, FY27, there's certainly more clarity. FY26 is, 70% recession chances in the US has got whittled down to 35-40%. But still, there are chances of a recession. If that chance is going to come down even further, that definitely bodes well for Indian IT names. And as far as the stock performances in the US is concerned, of course, these names are not exactly comparable with that of Indian IT names. Nvidia yesterday hit a $4 trillion market cap number. So, from that point of view, again, I would believe that second half should be better than the first half in terms of Indian IT vendors. And obviously, I am of the firm opinion that FY27 is going to be far better than FY26.
Okay, okay. Manish, let's talk about the banking sector also, because the early bank updates did suggest a slowdown in the credit growth, and the margins could be in check due to the repricing of loans as a causality of the rate cuts. But how would you suggest to investors to play the entire PSU versus the private lender pack at this point of time?
I think valuations favor the public sector banks, and even the earnings for this quarter is going to be much better for the public sector banks vis-a-vis the private sector bank. There's going to be, first of all, the credit growth in the system because of very low inflation is likely to be high single digits. It's not going to be double digits per se. Secondly, there is going to be, some sort of margin headwinds because of repricing of the loans, which are to be reset based on MCLR or repo linked. And, that is basically going to be more pronounced for the private sector banks. And, even the mark-to-market gains on the bond portfolio, the investment book, is going to be more pronounced for the public sector banks as opposed to the private sector banks. All in all, I think considering valuations as well as growth, there's high degree of margin of safety in the public sector banks at these prices, and they would be a preferred lot to be picked up in the current market situation. I would not to say that we are not in favor of private sector banks, the large private sector bank, but that's more for the medium term, not exactly this one.
Okay, okay. Manish, everyone is betting on FMCG. Are you bullish on this particular space too, given that everyone is betting on some sequential recovery in volumes, some pickup in demand from the urban pockets? What are your perspective?
So, I think on the consumption side, more favorable towards discretionary consumption as opposed to FMCG per se. But having said that, I think rural economy is turning the corner. Valuations are conducive, not exactly very cheap for the FMCG names, but still, if the earnings revival is there, it's going to be favorable. Out here, I would like to believe that urban FMCG facing companies are likely to face bigger competition from D2C brands vis-a-vis rural FMCG plays, where the competition is going to be less. And so within the FMCG space, I think rural facing FMCG companies are more favored in the current context, given the growth and the valuation.
Okay, okay. What about the entire QSR space? Because last quarter we saw an average revenue dropping by about 9% or so on an average basis. Can we expect things to improve from this quarter onwards?
More like improvement likely to come from the second half of this year, but obviously, on a sequential basis, things are likely to improve because of slightly more money in the hands of the middle class and, this income tax savings and obviously sentiments on the consumption side being better, given that inflation is benign. So I would believe that the space has really seen a heightened degree of slow down. Same-store sales growth have not really been up to the mark, but that's changing, and I think it's going to be more pronounced towards the second half in terms of numbers. But as they say that markets extrapolate the future, and obviously the stock prices would likely start to see the uptick, even from this quarter.
Okay, okay. What about the food delivery businesses? Swiggy, Eternal, both of them, they had faced some challenges in the fourth quarter also. There were rising expenses, competition got heated up, and there were some profitability challenges that also emerged in that quarter as well. But going ahead, how do you things to pan out for at least this quarter or even for the rest of the fiscal year?
I think it all boils down to unit economics of these quick commerce players. And I think all the three players and more coming in terms of competition. I think the right to win stands with the largest quick commerce guy, and he's got the unit economics right. He's expanding quite well in terms of opening of dark stores. His take rates are much better than that of competition. Competition is currently more believing in giving discounts and freebies, aggressively increasing the top line per se, but not so much on the profitability side. And I think markets ultimately would want to see the path to profitability more clearly. And I think that today is evident only from the largest guy, not the other two guys.
And how do you view the space, given that we are seeing some new entrants in the space as well? We are seeing Amazon's foray, we are seeing Rapido's foray. Do you expect, I mean, it's going to take some time, but slowly and steadily, but of course, any impact that you're looking at or from a larger perspective into the market share?
Competition is definitely looking like heating up because these newer players have deep pockets. They can disrupt pricing. But it's not a very easy business to do. And even if you have very deep pockets, the learning curve in this business is quite steep and it's quite long. So from that point of view, I think it's going to take some time. Some of the very large players have yet not been very successful. And I think the unit economics part, that is to optimize the catchment area vis-a-vis the riders. How do you optimize the company's profitability on account of effectively utilizing the riders to the optimum is going to determine how much money you're going to make. And that's basically a tough call. And even the large players are likely to face the heat. Having said that, they have deep pockets. They will disrupt the market. But the market is extremely big. Currently, quick commerce is only evident, so to speak, in the metros. Over a period of time, it will trickle down to your tier 2, 3 towns and cities also. So it's a much bigger place. But I think, as they say in retailing, it's all about getting your unit economics right. And then it's about expansion. So I think the unit economics part is likely to take the time. But expansion, India is a large country. There's a lot of headroom for growth.
Okay. Manish, now that we spoke a slew of sectors, anything that you're finding where there is growth elusive at this point of time? Anything that you're underweight on?
Capital goods, I think government spending is likely to get cut because we are living in an era where FRBM has got shrunk, which means that we are talking about 4.3% fiscal deficit, 6.5% real GDP growth. Revenue growth is not going to be more than 10.5%, 11%. You have defense expenditure that's likely to go up. And obviously, there has to be a cut from somewhere. Either the income numerator has to go up or the denominator has to come down for the FRBM to shrink. So from that point of view, I think expenditure side needs to be rebalanced. And private capex is still elusive. There's a lot of hope. But now even the government capex will see a shift away from government spending to defense. Government has a large balance sheet, 50 lakh crores sort of a balance sheet. But we got to see things at the margin, that is to say, compare this year versus last year. So from that point of view, I think valuations are quite elevated across the capital goods names. That is not to say that 2030 picture doesn't look all that, bad. It's great in terms of expectations, but near-term valuations are very, very full vis-a-vis the growth.
Okay. All right, just one last question before we let you go, Manish. Everyone is chasing for the Nifty to clinch that all-time high levels. But given the kind of earnings growth that we are anticipating from a street level perspective, do you believe that Nifty's all-time high, which is at 26,277 levels, would be sustainable?
Markets never stay in equilibrium and they either overshoot or undershoot. This time around, due to very benign liquidity situation, overdose of liquidity as well as lower cost of capital, I think markets are likely to overshoot on the upside. Yes, you are right. Earnings growth is not going to be more than 10-12% for this year and more like 12-13% for next year. 26,000 or thereabout appears to be very full valuations. But because lower cost of capital and high dose of liquidity, you'll likely see markets overshooting on the upside. It's only a matter of time. 26,277 is likely to be taken out. It's a buy on dip, unequivocal view. And I think this quarter earnings volatility should be utilized to the maximum, to one's advantage on the stocks that one wanted always to buy.
Manish, just any time frame that you have in mind for the Nifty to overshoot the all-time high levels?
I think in any case, the second half onwards, you have a very low base on the earnings of last year. So obviously, your fundamentals will look much better in the second half. And that is basically of around the festive season. We're already in the second quarter. Monsoons, predictions, etc. You'll come to know by August, September. So I think within a month or this quarter, July, August, September quarter, I would be surprised if we don't take the Nifty all-time highs this quarter.
Okay, all right. All right, with that, we have to let you go, Manish. Thank you so much for your time, and we hope that we connect with you soon.
Thank you.
All right, let's take a quick check of the markets at this point of time.